Hello and welcome back to another episode of the Retire While You Work podcast. I am Carson Odom, wealth advisor here at Adams Wealth Partner, joined by Myles Zuger, another wealth advisor here at Adams Wealth Partners, and lastly, Jeri Anne Agee, who is the director of operations here at Adams Wealth Partners. Thank you for joining us. Kind of a highlight in the news over the past handful of weeks. Interest rates are finally on the downward slope. The Fed decided to cut interest rates by 50 basis points or 0.5% last week. I believe it was at the time of this recording. And it's pretty big news. And it's also, we're used to this higher interest rate environment. I feel like over the past couple of years, ever since the Fed started hiking interest rates. And it's been one of those things where a lot of people have been asking the questions on the borrowing side, when are we going to feel relief? But on the other hand, on the savings side, everyone's been happy with the interest rates they're getting, especially with cash in the bank. I think it's not uncommon to be getting 4 or 5% with your cash sitting in the bank, which is kind of nice. This is the highest the Fed funds rate has been in nearly 20 years. I'm going to share a graph here just going over the interest rates that we have had here in the United States over the Fed funds rate. So the Fed funds rate is set by the Fed, and it's basically an overnight lending rate. So the big institutions use to meet their capital reserve requirements set by the government. This is what they're going to pay. It historically, before last week, as we can tell here, it was right at 5.25%, which is the highest that it's been since the mid to late 2000s, before the great financial crisis. And this, as you can tell by the velocity of the Fed rate hikes, or how fast this interest rate went from 0 all the way up to 5.25, this was the fastest rate hiking cycle in history. Extremely quick, really shocked the market. We'll get into how it impacted the market and the bond market and how we expect things to go forward. So this is where the Fed funds rate has been historically. So a trend you might see, the gray shaded area is U.S. recessions. And, you could kind of notice a season of higher interest rates. Then they begin cutting, recession hits, and then we start the process over, raise interest rates, and then they begin cutting, and then a recession hits, and then we start again. This was around COVID in 2020. Obviously, that wasn't the recession in 2020 wasn't from Fed policy or anything economically that was under our control. It was really from the COVID pandemic and having to shut down the economy. So really, the overarching theme here is what's the deal with the Fed funds rate? What's the target here? What are we doing by raising and lowering interest rates? I have a graphic, but I don't know if you want to speak to that, Myles, a little bit.
Yeah, you showed that chart there. I think people got used to from the late 2010 or early 2010s to, if you're looking at that chart, and for those listening, it was like, so maybe 2015, they started raising rates. There was a period there of, call it, 4 or 5 years where I think people got used to call it zero rates, and borrowing was very cheap. And then even from, 2015 to that 2020 range, they crept up to maybe 2%, where, at those levels, borrowing's pretty affordable. I think, kind of the standard, or what economists talk about, is that anything over rates over 4% is what they consider restrictive, meaning businesses and maybe individuals aren't as willing to want to take on debt because the financing is just a little more expensive. And it obviously, if you're a business, that cuts into profits. And so it's even in the 2015 to 2020, that range, borrowing was still pretty affordable, call it around 2% on the Fed funds rate. And then for the last from mid 2020 to 2023, 2022, somewhere in there, rates were kind of again at zero, to where people were getting mortgages at 3%, and some cases sub 3%. I know we have some clients who have a 30-year mortgage at like 2.875. And we always say they should frame that, because you're probably never going to see that again.
That's what I have.
Yeah. And so it's like,
I don't know that I'll ever move again, but I have a question for y'all on something you just said. So the Fed's funds rate was what, 4.5 on that chart?
Yep, 4.75 right now.
Okay, so then how much is added to that for other rates, like mortgages and HELOCs and cars? And
it's usually like I mean, it's never the same. I think like on a mortgage, you always say it's, maybe 2 to 3%. I think when, mortgages were maybe at like 6.5%, they dropped rates. I think you're starting to see some now at like maybe low sixes, like around 6. I've talked to a couple mortgage people who are, kind of saying that. Their biggest thing is that, I think people think with these rate cuts, mortgages are going back to 3%. And Jeri Anne, to your point, there's a markup on there's the Fed funds rate plus a markup so that banks or who's ever lending the money can make some sort of return on that money that they're willing to lend out. And so when rates are anything but zero, they're going to be marked up a little bit over what we're seeing on this Fed funds rate. So it's not like we're going to see mortgages back at 3%. We're probably going to see, I'm not going to quote a number, but we're not going to see them back there. And again, to any other debt, I don't know specifically like what a car loan gets marked up, but loans that you're taking out personally and for a business are going to be a little bit more than what you're seeing on this Fed funds rate that we're quoting.
That's right, because the Fed funds rate, remember, that's an overnight rate. So you got to think about the duration of a Fed funds rate is like 1 day. So I mean, that's just, it's spoken in an annual term, but that's the Fed funds rate. That is really, really, really short term. Then you go on the opposite end of that spectrum. You've got mortgages. That is a 30-year note. That's going to definitely be priced differently than the overnight rate. That's the Fed funds rate. Then a car loan, anywhere from 3, 4, 5, 6, 7 years. That's going to be different than a mortgage. Then a HELOC, that's a variable rate. So it's all loosely based on the Fed funds rate. So I have up here a graphic. It says the goal of Fed rate hikes. As we know, coming in 2022, inflation was out of control. I think it got up to 8 or 9%. Consumer spending was hot. Unemployment was still extremely low. Tons of money that flew into the economy by the government coming out of the pandemic. Stuff was essentially too hot. The economy was too hot. So the Fed says, okay, we have to slow things down. And we increase rates, which as a graphic depicts, mortgage rates rise, business loan rates increase, credit card rates increase, personal loan rates increase, variable loan rates increase. Everything increases across the board. So it goes from this, rates are at zero. Why would I put any money in the bank? Let me just spend it on anything and everything. To now, rates are going up. It's a whole lot more expensive to buy things. And hold on, I can get 3%, 4%, 5% in the bank by stashing my cash in there. The Fed's goal in this black bubble, it says less borrowing as it becomes costlier, which then leads to less growth, which then leads to lower inflation. The Fed's dual mandate, keep unemployment in balance along with inflation in balance. And that's the whole idea of this cycle of raising interest rates, is to just keep the economy in balance. Like we saw, there was too much spending, there was too much cash out there in 2021, 2022, which led to inflation. So the Fed needed to slow things down. Now interest rates are higher. Now we're on the other side of that. Interest rates have been higher. They raised them. They've kept them high at 5.25 for, I don't know how long they've been as high as they are, maybe a year since the last time they hiked rates.
Yeah, I think it was like almost, I think like around a year. Yep.
Okay. So now they're on the downward cycle. So now what the Fed is doing with is unemployment is starting to creep up. It's not bad. I think it's still below the long-term average. It's unemployment starting to creep up. Inflation's really coming down. We have the 2 handle, so it's sub 3%. Prices are still going up. That doesn't mean prices are going down. It's just they're going up at a slower pace. So now they're trying to keep that in balance. They're trying to make sure that we don't have another financial crisis or another dot-com bubble in 2000, 2001. And it's an extremely hard job. So that's what all these phrasings of, are we going to have a hard landing, a soft landing, no landing? It's all related to, can the economy stay in balance with the Fed dictating how they're going to keep interest rates lowering? And, we say interest rates are going to be X percent, 3% by the end of 2026. Nobody knows, because it's all based on data that comes in on a weekly and a monthly basis. It's all, how is the economy doing? What is our gauge of the economy every single week, every single month?
And I think to your point, like when you hear about the soft landing, basically they're trying to like ease things into perfection, which is a really hard job, because a lot of these, whether they're raising rates or lowering rates, a lot of these effects aren't even felt in the markets for 6 months plus. And so you're trying to, lower a rate by 50 basis point that you're not really going to feel in the market until, sometime into next year, let alone making, according to what the Fed's saying, probably a couple more cuts this year that are then felt 6 months after and 6 months after that. So it's like they're laddering it in. And so it's a very hard job in general. I mean, I think they get a lot of criticism, but it's not like they have an easy task to try and perfectly balance unemployment and the inflation number when you're projecting things out into the future.
And Carson, you touched on something that, so when they're lowering the rates, obviously everyone's like, great, great. But then on the other side of it, people have been getting a lot of a higher yield on their cash in the bank. But now that those rates have gone down, those yields are actually going to be going down too.
Yep, that's right.
So
So you'll, I bet a lot of people have noticed that your savings account at the bank, it probably wasn't very quick to go up really fast as the Fed was raising interest rates, or maybe it even hardly increased as the Fed was raising interest rates. Now, money market funds are a little bit better. They're a little bit quicker to respond to interest rates to the upside, but also on the downside. So money market funds, as soon as the Fed starts decreasing rates, your rate is going to start decreasing. So for an example, let's say a month ago, your money market fund was, had a rate of 5%. That was its yield. But realize that's on an annual basis. So that means over the course of the year, if the rate doesn't change, you're estimated to get approximately 5% yield on your money. But what if the rate changes? So now all of a sudden, the Fed started lowering interest rates this past week. Now you're sitting at maybe 4.5% on that money market fund. Then by the end of the year, it's going to be 4. Your total return for the year, while you thought at the start of the year all the way to now was going to be 5%, is all of a sudden cut short because the yield you're getting on that money market fund is already a lot lower, responding to the Fed lowering interest rates. So that is somewhat of a word of caution to people who have large amounts of cash where you're getting 5%. That is a variable rate that is not locked in. And you could find yourself a couple of years from now getting 2% on your money when there's a lot of opportunity elsewhere. Now, not to say nothing's guaranteed. Opportunity elsewhere means taking risk with your money, but there's different degrees of risk you can take instead of just sitting in cash. Because sitting in cash also is risky, reinvestment risk. You're not going to get the interest rate you have today in a month from now, more than likely. That's risk.
Yeah, and I think just to clarify if it's checking savings, it should always just be in that money market account, like money that you're going to be spending. And I know that's what you meant, but just to kind of clarify, like if it's just your checking savings, no point ever taking any risks with that. Be happy with the 2% you're getting or whatever that number is. And that's where that always should be. The risk is with money that you maybe is longer term money, but you liked the security and the safety of that 5%. But now as it's going away, you need to look to transition that. And obviously keep back what you're going to be spending in that. But if there's any portion of that can be put to work in stocks, bonds, or other real estate, other types of investments, it could make sense to start exploring those ideas.
That's right. And when I mean the reinvestment risk, so there's other, just because let's say you're sitting on a lot of extra cash, and you haven't invested it yet, just because the stock market feels risky. It's at all-time highs right now. Things going on around in the economy, stock market, news, so on and so forth, that would cause anxiety about putting money, especially from cash, into the stock market. So kind of what's happened with interest rates back in 2022 when the Fed had their fastest rate hiking cycle. I like to draw it as an X. If we had a whiteboard in our conference room, I'd draw it as an X, meaning that we had a period of time where the Fed raised interest rates extremely fast. And generally, interest rates and bond prices are inversely correlated. So what that means is as interest rates decrease, all things equal, bond prices go down. Because the thought is if I have let's just say a 1% bond back whenever interest rates were low, and now all of a sudden the market is issuing 5% bonds, who's going to want my 1% bond anymore when they can go to the market and go buy a 5%? So I have to discount it to a point where it's equivalent to getting a 5% bond. That's why bonds can lose price, can lose value. Now, on the other side of that, now all of a sudden we're at a higher interest rate environment and rates are about to decrease. So if I have a 5% bond, 2 years from now, the market's given 2 or 3% bonds. Heck, everybody's going to want my 5% bond because they can't get that anymore. So now all of a sudden, bond prices can increase in value because you can't get that good of an interest rate anymore. So the theory here is as rates decrease, cash becomes less attractive as a long-term investment, like you said, Myles. But there are other ways to invest without taking as much risk as in the stock market by some sort of bond portfolio. Now, there's a million different types of bonds out there, but you can take a smaller amount, an incremental amount of risk to say, hey, let me buy some bonds as rates decrease to have the potential to get better return than just your cash sitting in the bank. So that's just a way, if you're sitting on excess cash, just to reflect and think, how do I want this money to look 2, 3, 4, 5+ years from now? If it's you're trying to go after better return, look towards taking a small amount of risk, get out of cash into some sort of fixed income type of investment. But like Miles said, if it's there for an emergency fund, if you're going to be spending it inside of a year or two, keep it in cash.
And that's what we suggest for people that are scared of the market right now. Obviously, we would say diversify and do something more with that money rather than just bonds. But if you're still wanting to be just really conservative,
that's right.
Right.
Mm-hmm. Yep. And, it's one of those things where it relates back to time horizon, especially if you're on more of the stage in life where you're retired, you're living off your money, then you don't want to take as much risk, even though it might be 10, 20-year money. Then again, maybe your risk tolerance isn't there. So yes, you don't need as much money in the stock market. But you need to have an adequate amount of cash, but you can take a little bit more risk to get potentially a lot better return.
And right. And what we always say too is if you do have money in bonds and the stock market tanks and you need cash, then you don't have to ever sell stocks when they're down because you have that money in bonds. So people don't think about it that way sometimes.
That's right. Yeah, there is still some risk with bonds, but ideally they should be down a little bit less than what stocks are in a down market.
Yeah, that's right. I think Warren Buffett's number one rule of investing is don't lose money in the stock market. And the way you don't lose money in the stock market is not ever having to be in a position where you have to sell stocks while they're down. It's always having enough cash or bonds or other investments that are positive while stocks are down to ride out the period of volatility on the downside with stocks until they recover. Then you can sell them once they've recovered their investment. But
maybe we should touch a little bit too on maybe just how rates, whether rates are being hiked, rates are being lowered, how that affects the stock market. And I think the easiest way to think about that is if the Fed is raising rates like they were, over the last couple of years, the assumption with stocks is that businesses are going to be less willing to take on debt to grow their business or return profits back to investors because the cost of doing so is more expensive.
Mm-hmm.
And so the assumption there is that profits for those companies maybe aren't going to be as high. And so you see maybe stocks down sometimes when they're raising rates. On the flip side, the assumption when rates are being lowered like they are now is that those businesses, especially the smaller ones who aren't as fortunate as like a large cap company to have excess cash, like you hear about Apple sitting on like $1 trillion or whatever that number is. A small company doesn't have that ability or that luxury. So they have to take on debt to grow. So the assumption is that when rates are lower or being lowered like they are now, those companies are more willing to take on debt to continue to grow their company, which in turn should increase their profits and grow the business. And so investors are more willing to or wanting to invest in a company like that because they think that those companies will grow when they're able to take on debt at affordable prices.
That's right. There is
really, you could say it's like that chart you showed that had the green background. It's like just flip all those words to the exact opposite. And that's what happens when the Fed's lowering rates or raising rates, whatever the opposite of what that chart was.
It's stimulating. That's right. When you go to a lower interest rate cycle where you're lowering rates, it's attempting to be more stimulating than where they were at a higher level. Now, rate cuts, a lot of times, I showed that chart talking about the Fed rate cuts, and then when they start cutting rates, you have a recession. Well, there's also cycles. We go back even more decades into the earlier 1900s. We look at a larger data set. There are cycles when the Fed starts cutting interest rates and there's not a recession. Whenever there's not a recession, history shows us that the returns, what happens to the stock market after the first Fed rate cut, it's absolutely everywhere. There's 1 year from then, stock market's up, some situations, stock market's down, it's flat. There are so many other factors other than the Fed rate cutting cycle. So just because the Fed is entering a rate cutting cycle, And the past couple times that this has happened, we've had recessions. It does not mean a recession is guaranteed just because the Fed is cutting rates. It does also not mean that the stock market's going to go down just because the Fed's cutting rates. There are so many other factors. Heck, there could be a black swan event next year that none of us even have any knowledge of that impacts the stock market. But then that would just be another point on the data set that says we have a recession after the Fed started cutting interest rates, and it would just, the media narrative would take off with that. But there are, just because the Fed's cutting rates, there's a scenario where we have a soft landing, the economy doesn't fall apart, and the stock market continues to rip. There's a scenario where there's some tougher parts of the economy come to surface. There's some sort of correction, bear market in the stock market. It doesn't mean the world's going to end. There's going to be volatility. Heck, we're heading into a pretty wild election season. There's always, there's a lot of times there's increased volatility in election seasons. So don't let the media headlines of interest rate cuts impact how you're going to invest for your 20 and 30, 40-year time horizon. We're going to look back a long time from now, and whether the Fed lowered 25 bips, 50 bips, it's going to be very, very insignificant in your long-term financial plan.
I wonder how many times, I mean, I'm sure we could get this data, but when they lowered rates like that, that we didn't go into a recession. I mean, I'm sure there's many times, but.
Yep. Looking back at, I don't know, this is 10 or 12. So 1, 2, 3, 4, 5, 6, 7 times there was no recession in the next 12 months. 1, 2, 3, 4, 5, 6, 7, 8, 9. 10 times there was a recession in the next 12 months. So 60-40, that there is sometimes a recession. But also in those recessionary times, the stock market 1 year later was still positive, even if there was a recession. So just because there's a recession 1 year after the Fed starts cutting rates doesn't even mean that the stock market's going to be negative. There was only, in this chart I'm looking at, like 4 times where the stock market was negative 1 year later. So things where the media loves to paint a negative bias with Fed rate cuts. The media loves to say how, the past 2 times we've had a recession hit, the stock market's corrected 50%. Anything to get the views and get people to worry about things. I'm not saying that's not going to happen. I don't know. Myles doesn't know. Jeri Anne, David, none of us know. But it's one of those things where I think we all invest and we all like to focus on things that are that trend in history. And what trends in history is the longer your time horizon, the longer you let your money and your funds do their thing over time, the higher likelihood of the higher chance you have of being positive in the stock market. So we know over the next 12 months, it's going to be wild. Who knows? Stock market is going to be up or down, but we start zooming out to 3, 5, 10 years from now. History shows us that you have a higher chance of being positive in the stock market, despite all the noise.
And I think when you're, an individual or a business who's maybe trying to figure out, like, should I take on this debt? Should I buy the more expensive house or try and grow my business? I just think of it as, if you can afford it at these current rates, even at these elevated rates, if you can afford it there and it makes sense for you, go ahead and do it. You can always refinance, but also don't do it with the expectation of things are very tight. I hope we can, the plan is to refinance. It needs to be from a long-term financial planning perspective that you can afford it with rates where they're at, and not the expectation that you're going to be able to refinance at lower rates. That's just kind of like icing on top of the cake if you're able to refinance that at lower rates and keep everything else the same, because then that debt becomes more affordable.
That's right. Yep. I remember talking about that a couple of years ago when mortgages first started going up, and we were getting to 4 and 5%. You might have heard online, just buy it now, refinance later. Well, here we are 2 years later, and you're probably still not refinancing. And so hopefully people made decisions 2 years ago to purchase that house based on the fact that, can we afford long-term to make these monthly payments? Still do the same thing. I think we're closer to opportunities to refinance. If you buy a house now, it could be 6, 8, 12 months when you have an opportunity to refinance. It's not that,
or like they do the arms, the 5 and 7 year arms. I mean,
that's
right. I think surely in 7 years there's going to be a chance, but I don't know.
That's right. It's one of those things where maybe not. So, purchase a home based on your ability to buy it today. Don't bank on refinancing. Yep.
Agreed with all that.
Yep. That's like saying, don't invest in the stock market. Just wait for the bear market, wait until it goes down and then buy. Because that probably doesn't work.
We know that works. Not.
But anyway, there's a lot of noise out there with the Fed, interest rate cuts, hikes, how it's going to impact the stock market. If you're a client of ours, talk to us, sit down, how it impacts your portfolio. Let's talk through how much you have in equities, how much you have in bonds, what's your overall allocation, how much cash should you have? Because those are some of the most important things, and is how this relates to your personal financial plan. So, but anyway, that was a pretty good topic. Thanks for joining us on the Retire While You Work podcast. Look forward to having y'all in here next time.
Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. The information contained in these podcasts do not purport to be a complete description of the securities market or developments referred to in this material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Every investor situation is unique, and you should consider your investment goals, risk tolerance, and time horizon before making any investment. Prior to making an investment decision, please consult with your financial advisor about your individual situation. Any hypothetical examples are for illustration purposes only. Actual investor results will vary. Raymond James does not provide legal or tax services. Please discuss these matters with the appropriate professional.